The Australian share market defied gravity today, staging an unprecedented 270-point turnaround to finish higher. Analysts were betting the US Federal Reserve would embark on yet another round of quantitative easing, as we've heard, to help break the cycle of selling, which has gripped world markets. Some were also wondering whether Australia's Reserve Bank might have to engage in a rescue mission of its own by cutting interest rates. Here's Philip Lasker.
Today's trading started like a rerun of the horror show investors have been watching for the past week.
The 87 crash, the Asian crisis, the start of the GFC, they're all fear-based. And it's very hard to understand or know just to what extent fear will drive a market. And the market at the moment is just totally gripped by fear.
The volatility was remarkable. After plunging more than 220 points in the first hour, the market staged a breathtaking 270-point turnaround to finish 48 points up, over the 4,000 mark. Analysts put the rally down to speculation that the US Federal Reserve will announce another round of quantitative easing overnight. But Jeff Wilson says, unlike previous market traumas, this crisis will take much longer to resolve.
We were of the view that we wouldn't see the start of the next bull market till the end of 2012 or early 2013. And so we're still of the view that it's going to take a reasonable amount of time for countries to work through the current problems.
Fears of a global recession saw the Australian dollar fall 3.5 US cents, at one stage diving below parity for the first time in 5 months. But that speculation about another round of stimulus saw it regain some of the losses.
Last year, the Fed governor basically made it very, very clear that we were moving towards QE2, and that really was the green light for FX traders to take the Aussie from 90 cents to parity. So the importance of the Fed meeting tonight, I think, is very, very significant.
If the dust doesn't settle, the Reserve Bank might have to act. We'll know when this crisis enters a more dangerous phase for the Australian economy, because the Reserve Bank, which has been signalling interest rates are more likely to rise, will have to cut them instead.
I think it's much more likely that the Reserve is going to sit on its hands for quite a while. Remember, this is a Reserve that last Friday said the domestic economy was going to increase the best part of 4.5% in the next 9 months, and they had an inflation problem. So I think you really have to convince the Reserve that they're fundamentally wrong in their outlook before they do anything.
In the meantime, some of Australia's major lenders did something, passing on a fall in funding costs by cutting some fixed-rate loan products. Now it's back to the routine of waiting to see what the Northern Hemisphere throws up.